Hello, I'm Jonathan Hall. That is Brian Grant, and we are financial advisors with Warburton Capital. And whether we are meeting with clients or hosting this podcast, our goal is the same: to help people grow their wealth and define a purpose for it that moves them towards peace. So today, Brian, I want to touch on a topic that we discuss with our clients frequently. In fact, we have a meeting in about an hour to discuss this with the client. And it's really a universal reality from almost every retiree. It's the required minimum distribution, or better known perhaps as an RMD.
Yep.
So I thought what might be fun in this episode is to walk people through what an RMD is and what some of the rules are, what some of the gotchas are, and then how we help clients navigate that. I think I'll start with just the basic premise. So the basic premise is that in a traditional retirement account, like a 401k, an IRA, where there's a tax deferral, you put money into this account pre-tax. It's been allowed to grow for all these years with no tax due along the way. And there's a chance that someone might do that, put the money in, not pay tax, have it grow for all these years and never actually end up using it, right? And if that were the case, then the government would never actually get any tax paid on that money or on the growth, right? And so the RMD is essentially a structure where the government is requiring us to take money out of the IRA once we hit a certain age every single year until the end of our lives in order to eventually pay tax on that money. And so I thought I'd start there, Brian, before we go into the specifics, but that's what an RMD is.
Yeah. Yeah. No, I mean, it's the IRS basically says we've been nice as long as we can and let you defer taxes, but we need our revenue at some point. And
Yeah.
so, eventually that time comes. So I guess, when does it apply to you? If you're born, for almost everyone, right? If you're born before the 1950s, there's different rules. But if you're born in the 50s, you're going to have to start taking R&Ds the year in which you turn 73. And if you're born 1960 or later, it's moved back to 75. So that's something to keep in mind. And technically, somebody might say, well, technically, you can delay your first one until April 1st of the following year from when you turned RMD age. But that can come with some gotchas. There might be good reasons to do that. Maybe your actual RMD age was a huge tax year for other reasons, and so it's worth it. You kind of do the math. Because otherwise, what's going to happen if you delay is you're going to have to take your first years and your second years in that same calendar year.
Right.
And that can have some unintended consequences, right? I mean, just higher taxable income, maybe trigger IRMA for Medicare premiums going up, make more of your Social Security taxable. There's all these little nuances to the tax law. So in general, most people just start at that 73 or 75 and it's annual. And I guess let's kind of talk about how it's determined, right? So I don't know if you want to touch on that.
Sure, yeah. So how an RMD is determined is essentially the IRS has this life expectancy like table or calculation that they've done. And basically that table that's issued becomes the guidebook that you have to use. You have to do this math equation of that multiplier against the value of your IRA. But it's not your IRA on any given day or the day that you take it out. It's actually December 31st of the preceding calendar year, right? So December 31st of, right now it's 2026. So your 2026 RMD would be based on the balance December 31st, 2025. So now that's interesting. What if the market tanks in December of 2025 and you had a lot of equity exposure in your IRA? That means your RMD is lower for the year and vice versa. So that's just a snapshot. It doesn't matter what all is happening. It also doesn't matter, this is interesting, it doesn't matter how many IRAs you have open. So if you have an IRA open at, I'll pick on some custodians at Schwab and one at Fidelity and one at, I don't know, Raymond James or something, then you could go take an RMD from each of those places, but you have to, the IRS looks at your IRA as the combination of all three of those, right? And so You have to get the aggregate balance of all 3 of those against that multiplier and make sure that you're taking enough money out because there are penalties if you don't.
Right. That's the big thing, right? I mean, and your custodian usually will help you calculate the RMD. Fidelity, Schwab, whoever it is, will say, "Hey, your RMD this year is 15 grand, whatever the number." But like most things with the IRS, it's on you ultimately, right? You need to make sure you get the right number. Um, and you're exactly right. There's penalties. They used to be even more punitive, but still, I think it's a 25% penalty if you correct it relatively timely. That drops to 10%. Who cares? I mean, the point is, why have a penalty at all? It's
Mhm.
easily avoidable. Um, and some people will say, "Well, I don't need the money. Why do I have to take it out? I don't need it's, again, this is the IRS saying, we're not telling you have to spend it.
Right.
And maybe we'll talk about that next. Like, what can you do with the RMD?
Sure.
Um, but you have to take it out of that IRA. That's now ordinary income. That's how it's taxed, the full amount of the distribution. And what you do with it is up to you, but it needs to leave so that it triggers the taxability and therefore you paying in those taxes on the distribution. So those are the big rules. But as far as what you can do with it, super open-ended, right? I mean, you certainly could spend it. So maybe if you up to that point were pulling a certain amount from your brokerage account, from your taxable assets, let's say, um, maybe now that R&Ds trigger, you lower the amount from that account and increase it by, whatever's coming from the IRA makes up the difference. And you can withhold for taxes. That's another big thing. You can distribute if 20 grand has to come out total. You can say, well, I think I'm going to be in the 22% bracket federal and this much for state. And so I can withhold for taxes and just get the net amount sent to my bank. That way, just like a paycheck, right? You don't have it all due at the end. But there's other things you can do with the
And the
RMD.
tax withholding counts
Mhm.
towards the RMD as
For sure.
well.
For sure. Yep. But you don't have to spend it, right? Many people will, whether they withhold from taxes or not, they'll say, "Well, I don't need it. I have other income or have other ways to cover my bills. Can you just move it over to my brokerage account and reinvest it?" That's a great option, particularly if. So I thought about this when you outlined, what if the market tanks in December?
Mhm.
What if the market tanks in January? Right. So now we had this big run up, let's say, and you're at an all time high account balance December 31st.
Yeah.
The market tanks in January,
Mhm.
and doesn't matter. The IRS says it's based on that 12/31 of the preceding year's balance. So, it can be particularly helpful in those cases if you don't need it to reinvest it and hopefully ride that wave back on the upside in the brokerage account. And that counts. As long as it's moving out of the IRA, that's what matters.
And if I may,
Mhm.
um, that exact point highlights how working with a professional, a financial advisor like us, can really help you when it comes time to start taking R&Ds. Because even that decision of, the timing of the R&D, at what point throughout the year do I take it? Do I take a little bit each month? Do I take it all at once? Take it in January? Do I take it in December? How is my underlying account allocated so that I can take money out of it? Um, but I don't want to take money out while the market is in free fall because it's all in stocks. Well, maybe we should have had some bonds in there, right? So making sure that this RMD is a known thing. We can we can't tell you exactly what it's going to be because, again, we don't know what the market's going to be doing in December of each year until that time is passed. And then we know.
Mhm.
But we can, as we're creating a retirement plan for somebody, we can look to the future and say, we know under current laws what this R&D structure is going to look like. We can start planning for it. So in these years ahead of retirement, maybe we're living out of the taxable account to try to keep our ordinary income as low as possible. Because like you said, those RMDs are all ordinary income.
Mhm.
Or maybe we're doing Roth conversions during this year where we've retired early and there's no social security. Maybe that makes sense to try to get the future RMDs down by getting that account balance low. Or maybe we do the opposite. Maybe we actually live out of the IRA because we're trying to get the balance low so that the RMDs are lower. Because at that point, we have more Medicare, we have more impact in this tax world. There's IRMA, there's taxation of Social Security.
Right.
So maybe we want to take more out early. It's one thing to know that those strategies exist. and to be able to Google it and know that those are things that you can do. And it's another thing to have the training and the experience and the expertise to know when that strategy applies in your situation. That's how a financial advisor can truly help.
Yeah, for sure. No, those are great points. That's one of the things I was going to say was, if you're watching this and you're thinking, okay, I'm not 73. I'm not going to be for quite a while. It doesn't apply to me. Man, that's not true because there's so many things you can do purposefully to avoid bigger impacts later on, right? I mean, sometimes you would voluntarily, want to have a little tax friction now to avoid massive tax friction later, right? I mean, if you can live out of the IRA a little bit strategically leading up between retirement and RMD age, and that keeps you in the 22-24% bracket, but maybe avoids what your RMD otherwise would be if you never did that, and that account grew and grew till you had to start taking it, and now all those distributions push you to the 32% bracket, right? So sometimes everybody wants to delay taxes, and I get it, but sometimes it's worth it to pay a little more in taxes now because presuming you live a full life, you're going to actually pay less over the long term. So that's a big point. And whether that's Roth conversions or that's, again, just living out of the IRA, splitting some of your withdrawals between the IRA and the brokerage, there's ways to do, and we do this with people all the time, say, where does your tax picture lie without these things factored in? How do we kind of maybe fill up a bracket, let's say, through a Roth conversion? I think another good point about a Roth conversion is a Roth conversion can't satisfy your RMD.
Great point.
Right? You can't, if you're 73 or 75 and it's the first year you need to take an RMD, why? I don't know. I get it because you could say, well, why do they care? I'm pulling it out of the IRA. I'm paying the taxes. Why doesn't it doesn't count? I don't know. Ask the IRS. So you can still do Roth conversions once you're RMD age, but that amount you convert from traditional to Roth does not count to satisfy your RMD. But, and you maybe talk to this, this is something we do all the time. We see clients do all the time. If you're charitably minded, there's a great option once you're RMD age, and that's QCDs.
QCDs. So we're entering into alphabet soup territory now. We've got IRAs, RMDs, and QCDs. Yep. A QCD is a qualified charitable distribution. And what you can do, and it's interesting, notice when these laws get updated, some of the ages change over the years and some don't. So when I took my CFP exam, over a decade ago, I think at this point, and was studying for this, the RMD age was 70 and a half. No matter when you were born, that was the age. And so that's the RMD age that's tattooed on the inside of my brain, but that age has changed multiple times since we've been practicing over that time period. And now it's bifurcated into these two different ages. The reason I say that is your ability to do a QCD actually has a different age than either of those associated with it, which is age 70 and a half. Mm-hmm. So that's back to that old RMD age. They updated the RMD age and never updated the QCD age.
Yep.
Interesting. So now, again, working with the planner, a financial advisor, we know that we have to keep up on this stuff. We have required continuing education that we have to do. So we can actually now incorporate even the difference in ages in your planning, because a QCD is a powerful tool. Let me actually get to what that is. So we can, if you give money directly from the IRA to a qualified 501c3 charity, then you can, it's kind of like it just gets picked up from the IRA and given directly to the charity without ever hitting your tax return. Mm-hmm. It's not added as income to your tax return. It's not something that you have to then go deduct later. You don't have to give enough to be able to do itemized deductions rather than, so it goes directly from your IRA to the charity. It never hits your tax return. And that's a beautiful thing. There are limits on how much you can give each year, but that does satisfy your RMD. So Roth conversion does not. That does. So once you're RMD age, typically when we're working with clients, if you are from a faith background where you want to give 10% of your income to charity or to your church or whatever, Okay, all of that needs to be coming out of the IRA at this point, right? Or if you have a charitable budget otherwise, then once it's RMD, or actually once you're over 70 and a half, it's really smart to start thinking that way.
Mhm. Yeah, there's no reason not to. If you're already giving to charity, right, then there's no reason to have it come from the IRA and avoid taxation altogether. Because people get hung up on that. They're like, "Well, why can't I just distribute it and then take the deduction and it's the same?" And it's not. Like, doing it that way is kind of damage control, whereas if you do it straight from the IRA to the charity via a QCD, there's really no damage to control. Like, that's how I think about it. It's just, again, it bypasses your return. And that's important because even if even if you donate enough to where you could itemize, right, what you've still done then is raise your AGI, and then you're going to use these charitable deductions to offset what ultimately is taxable income. Problem is you've still raised your AGI, and that can trigger IRMA, that can increase the taxability of Social Security benefits, that has other downstream effects, even if you end up getting some benefit from the itemized deductions. But you got to give quite a bit. And the standard deduction has raised quite a bit. And then it's even higher now with a lot of the newer provisions and the big, beautiful bill that passed for people 65 and older. There's that increased senior deduction. So there's just a higher hurdle. So if you can satisfy your whole RMD or even a part of it, doesn't have to be all of it, by QCDs, man, that's a great way to do it. Again, if you're already giving to charity. If you're going to start giving to charity to satisfy the RMDs, great, but you are going to be parting with more dollars in order to save the taxes. So don't get hung up. It's not magic, right? But it's a strategic way to satisfy charitable giving you're already doing or that you already planned for without it impacting your taxes. So it's a great thing. I think the limit this year is $111,000 per person. So it's quite high. High enough to satisfy most people's full RMD, even if they wanted to give away the full thing. But it's a great tool, and it just has a lot of flexibility. It gives you a lot more flexibility. So
Yeah. And really, just to make the point one more time, Brian, you know, as planners, when we're helping our clients, grow their wealth and find a purpose for it and have that purpose move them towards peace, ultimately what we're doing is creating a plan for the long term, the short, medium, and long term. The reason I say that is in a plan, we can control what we can control, and we can't control what we cannot control. And it sounds basic, but actually grabbing onto that and believing in it and understanding that is a totally different thing. And we often think about that in terms of volatility in the market. We've talked about that before. We can't control volatility in the market, so let's control our exposure to it, right? That same principle comes about in planning like this over time. We can't control the fact that we're required to take a minimum distribution out of this IRA at a certain age. Can't control that. That's the law. We have to do it, but we do know it's coming. So we can control all the planning opportunities that surround it. We can make sure that we actually do it and that we avoid the penalty. We can make sure that we're looking at other elements of our plan, our tax planning, our charitable gifting, even our estate planning, our investments, the allocation of the underlying accounts. We can make sure that all these other pieces are working together to help satisfy your long-term goals so that just, oh, I need to take my RMD, and you just take it. Okay, well, you did satisfy the law, you did it, but how is that part of your overall plan? What are we actually trying to do here? That's where we really earn our stripes.
yeah, for sure. Um, the other thing I wanted to this is sort of unrelated, but I want to make sure we mention it before we wrap up. One thing we're not talking about here is inherited IRAs or
Correct.
inherited 401ks.
Thank you. That's a good point.
Those follow their own set of rules. They're honestly, that's a whole show in and of itself. There's a lot of nuance. What kind of beneficiary were you? Was the person already taking RMDs themselves when you inherited it? There's all these new rules once the Secure Act passed a few years back. So this does not apply to that. Maybe we'll cover that in a future episode. This is for your own traditionals, SEP IRAs, simple IRAs, pre-tax 401k deferrals, stuff like that. So I just want to make sure we threw that in there. But
And RMDs are not required on Roth IRAs unless you inherit them back to your earlier thing, inherited IRAs and Roth IRAs are totally different.
Right.
But they're not required on Roth IRAs. They're not required on Roth 401ks. There are some exceptions if you're still employed and your assets are in a 401k, then based on some very specific rules, whether you do or don't take an RMD, that's where having an advisor can be helpful if you find yourself in that situation. Um, Otherwise, your 401k, oftentimes, just another side note, with a 401k, each plan often will make you take an RMD. So if you have multiple old 401k plans floating around, which means you need a financial advisor because you don't need 401k plans floating around.
Yeah.
But if that's happened and you're in RMD world, um, typically each plan is going to say, here's your check. And they're just going to cut you a check and send it to you unless you elect to do otherwise. Whereas with an IRA, in our early example where you have a Schwab and a Fidelity and a Raymond James IRA, again, if you have that, you have confetti, you need a financial advisor
Yeah.
to help you simplify your life a little bit. But let's say you have that. You could theoretically take all of your RMD from your Fidelity IRA.
Sure.
And it would satisfy the RMD for all three as long as it was enough and you're
Right.
able to coordinate that.
Right.
401k plans are a little bit different. So now we're really getting into the weeds, but we can't help ourselves, Brian.
Yeah, well, because that nuance matters. I mean, these are the things that, again, if you don't attend to it ahead of time, it's coming. It's going to arrive, and if you haven't planned for it, then it's gonna happen to you in whichever way it happens, and so it's worth so I always go back to this thinking of, low fee is not necessarily low cost, right? People wanna save the fee. Well, working with somebody costs money. It does, but if that saves you more money than it costs you long term, it was well worth the expense. And so, whether you're leading up to retirement age or you're at RMD age or anywhere in between, thinking about those things now so that you arrive somewhere purposefully and that we can actually, do things in a meaningful way that saves you real money it's far better to think about that now than to wait until it's upon you. So that's what I would want people to do is, you know, spend time now making sure you're headed in the direction you want to be because that RMD age is coming. And if you plan for it ahead of time, it can be a lot less impactful to you in a negative way. So
I think that's a great note to end on. We're running out of time.
we always run up on time.
We always do. But that's because RMDs are so interesting to talk about.
Yep. No, but it applies to everyone.
It does.
So it's good to think about, and we can help you think about it more.
Absolutely.
Yep.
All right. We'll see you next time.